Hello there, everybody, and thank you so much for joining us this afternoon for one of our ExxonMobil focused webinars here at the Retirement Group. My name is Samantha, and I am in client services here. I moderate these weekly webinars. And in just a moment, you're going to be joined by Tyson Mavar, an advisor here at the Retirement Group, and he is going to be giving you a breakdown of the NUA tax strategy. But before I bring Tyson on, I would like to very quickly remind you that although we work very closely with both active and retired members of ExxonMobil, the Retirement Group is not affiliated nor endorsed whatsoever by ExxonMobil. We are a completely independent group of financial advisors here, so please keep that in mind. After Tyson's presentation, I will rejoin him very quickly to ask him any questions you may have entered into the Q&A chat throughout his presentation. If you find that you have a question throughout his presentation, please feel free to ask it in the Q&A box, and Tyson will answer as many questions as he can, time permitted, of course. It is completely anonymous, and we welcome your participation, so please ask away. And with that, I'm going to now turn off my camera so Tyson can get started. Hey, Tyson.
Hi, Sam.
Hey.
Thanks for joining us, everybody. My name is Tyson Mavar. I'm one of the ExxonMobil focused advisors for the Retirement Group. And on today's webinar series, we're going to be covering taxes, specifically the net unrealized appreciation strategy, as many of our clients from ExxonMobil have saved thousands of dollars in taxes by correctly utilizing the strategy. So today we're going to talk about what it is, how it works, how it applies specifically to ExxonMobil folks compared to anybody else that has appreciated company stock in their 401k, and some examples of how you can actually save money for yourself and especially for your family if this strategy applies to you. It doesn't apply to everybody, but for those that it does, it can be very, very lucrative. So specifically what net unrealized appreciation, or NUA for short, is a tax strategy wherein you can pay a lower capital gains tax rate on a portion of the shares that you have in your ExxonMobil 401k plan, or any 401k plan for that matter. And we found with the clients that we have from oil and gas companies, ExxonMobil being one of the ones that I have many clients from, stock has done very well over the careers of, sometimes 25, 30, in some cases 40-year careers. And we also have many of our clients that worked at ExxonMobil were very loyal to their stock and held on to it for a very long time, oftentimes having a larger concentration than we would like as advisors for our clients approaching retirement, but creating some very nice tax savings if implemented correctly. So big picture, what's happening is when you move the money from your ExxonMobil 401k plan, currently held at Voya, into an IRA, when you do your rollover, rather than rolling over the entire account, the shares that you select for net unrealized appreciation will move into a non-qualified investment account. Could be a trust account, an individual account, a joint account, just a non-retirement account. And you get to pick which shares you utilize this strategy with. Typically, it's only going to make sense for the lowest cost basis shares. But one thing that's unique about ExxonMobil, how they have the plan set up, is that they have kept track of all of the shares, and they let you pick a range of shares that you would like to utilize this strategy for. The reason that it's important to focus on the low cost basis shares is because you will pay income tax, ordinary income, on the value of the cost basis of the shares you utilize this strategy with. And we'll go through an example of how this works. And then later, you will also pay capital gains tax on the appreciation of those shares, rather than paying ordinary income taxes on 100% of the value of that money when removed from an IRA. So we'll talk about why you might not want to consider this strategy for some people, especially those that don't have that much low cost basis ExxonMobil stock in their 401k plan. And for those that do, how you can think about this when you're approaching retirement and what to get ready for to potentially save you, and probably even more so your family, tens, if not hundreds of thousands of dollars in taxes over your retirement days. So we have an example here of a client, Lucy Norton. Let's see if we can zoom in here. Total fair market value of her stock at retirement was $200,000. The cost basis, or what she and the company paid for the stock when it entered into her 401k plan, $50,000 in her case. So the net unrealized appreciation in her situation was $150,000. And for the purposes of this illustration, we assumed that she held on to that stock for 10 years after she left ExxonMobil, and it had doubled in value from her retirement date to that 10-year milestone, from $200,000 to $400,000. Not too lofty an assumption. That would be a roughly 7% rate of return annually over that 10-year period, and fairly common for our clients to want to keep their stock. In fact, we all oftentimes recommend our clients keep at least a portion of their stock, in some cases for the rest of their life. And typically, we're not recommending selling too much stock in one place. Oftentimes, we are dollar cost averaging out of the stock, or we're selling a little bit each year. Sometimes that's for tax purposes. Sometimes that's just to reduce the overall risk of the portfolio and the concentration in ExxonMobil. But in Lucy's situation, we assume she held on to all those shares for 10 years and then sold them at the 10-year mark in retirement. All right, so we want to think about the taxes associated with your ExxonMobil stock in three parts. On this bar graph on the left, you can see at the bottom we have income tax. So in the NUA strategy, you are going to pay income tax immediately when you do your rollover. Now, this does not have to happen the year you retire. It can be deferred. But one thing to keep in mind is that the net unrealized appreciation strategy, you must meet these triggering events in order to utilize a strategy. One of those is retirement. Another one is 59 and a half. And the last one is death/disability. Those triggering events are also considered opportunity events to utilize the NUA strategy. If you lose one of those triggering events, you may still have another triggering event and a new opportunity to utilize NUA. So for example, let's say you retire from ExxonMobil once you get 15 years of service and you're 55. That's the major milestone for retirement eligibility. But you need some money, so you take penalty-free withdrawals from your 401k between the ages of 55 and 59 and a half. Well, the other special rule that is a part of NUA is that if you take a distribution from your 401k plan, you have to utilize NUA or roll over the entire amount of your 401k by the end of that year, or you lose that triggering event. So for example, this individual, if they're creating some income post-55 distributions, that first year, if they don't do NUA or do the full rollover by the end of the year, they cannot do NUA until another triggering event is hit, which in their case, they still had the 59 and a half triggering event. Now, for somebody who retired after 59 and a half, took money out of the 401k and did not roll over the entire 401k by the end of the year and utilize this NUA strategy, they would have to wait till death or disability to utilize NUA, which for many people is not very ideal. So keep in mind, be very careful when making withdrawals from your 401k, when doing rollovers. Make sure you know all these timing rules and the special details of this type of a strategy, because it's possible you could ruin your ability to utilize what could be a very lucrative tax strategy. I'm going to zoom back in here on this. I wanted to take some time on that, but in addition to the income tax associated with the cost basis, which you see at the bottom here, you also have long-term capital gains taxes that are associated with both the appreciation on the shares during your career, as well as the appreciation on your shares after you rolled the money over. And the reason that we distinguish these two is because the green long-term capital gains, the future appreciation after you do the rollover, could be subject to a step up in cost basis, which means those taxes disappear if you went the rest of your life without selling those shares. So there's an additional ancillary tax benefit to spouses, to family members, to beneficiaries specifically of employees who utilize the NUA strategy, in that they could have an even bigger tax benefit than you because of the step up in cost basis that allows them to avoid capital gains associated with the future appreciation of your ExxonMobil shares after you did your rollover. There's no way around the capital gains associated with the appreciation during your career, but the future appreciation could be a big benefit. It should be considered in the estate plan. And we do this when we run our plans for our clients, when we're figuring out what stocks to sell to create income in retirement, when to sell them. Should we pull from the IRA? Should we pull from the non-qualified brokerage account? And this is part of the tax and distribution strategy that helps people to keep as much of their money as possible by navigating the tax code as correctly as they possibly can. You can see here also that the more income you have, the higher your tax bracket goes. That is also the case with capital gains taxes. Although most people are in a 15% capital gains tax bracket, all this needs to be looked at prior to making decisions, at least in our opinion, on when to sell a stock as well as when to make a withdrawal in retirement, because there are some pretty big tax implications. Now back to Lucy's scenario, we have on the left here the NUA strategy. So this is where she took those shares of stock, moved them to a non-qualified brokerage account, and rolled over the rest of her money in Voya, presumably, over to an IRA. Could be Fidelity, Schwab, Voya, Vanguard, any custodian who offers IRAs. Our company happens to use Charles Schwab as a custodian. And typically there's at least 2 accounts created when this strategy is transacted, at least a traditional IRA if one is not already established, and a non-qualified brokerage account. But oftentimes our clients also have some after-tax money in their 401k, wherein we will typically either recommend that they open a Roth IRA to move the after-tax dollars into, or sometimes we'll actually recommend applying the after-tax cost basis toward the taxable cost basis of the NUA shares in an effort to reduce the tax burden in the year of their rollover. So in Lucy's case, $50,000, that wasn't too big of an income tax hit comparatively. We've had some clients, I talked to one this morning who we're looking at doing NUA for him. He's been retired for 2 years and we're probably not going to do NUA until next year. And it's going to create about $250,000 of taxable income for him. But in his case, he's going to have very little ordinary income next year. So next year makes it a good year to do this for him, and a substantial tax savings on the projection of the strategy. In Lucy's case, $50,000 didn't hurt her too much. She was able to stay in the 12% tax bracket. She may have other income that year if she was taking withdrawals from an IRA, if she went back to work consulting or doing something after ExxonMobil. And that's something we also want to be cognizant of and considering when we're making recommendations on this. The taxes due up front in her case were just over $5,500, $5,589, based on the $50,000 cost basis value of her NUA distribution. Now remember though, she's not going to sell those shares of stock for another 10 years. Not that she cannot, this was just her situation. And we assumed that that money doubled in 10 years. So the appreciation is now $350,000, whereas originally it was only $150,000. And if she sells all of the stock in that year, granted, this might not be advisable for a variety of reasons. She's going to have something called NIIT, which is an additional tax on capital gains and qualified dividends, because her income as a married person over $250,000 is going to increase the cost of selling appreciated assets. We want to be looking at a lot of different aspects prior to setting up this game plan, if you will. But in her case, if she sold all that stock, she'd have capital gains of $350,000. Some of that taxed at 0%, some of that taxed at 15%. Taxes due on the capital gains when she sold the stock, $52,500, which means the total taxes she paid, both upfront in ordinary income taxes and 10 years later in capital gains taxes, in her case, were just barely over $58,000. The other scenario would be to just roll everything over, roll the entire 401k over to an IRA, pay no taxes up front, and sell the stock down the road. Now, remember, in an IRA, when you sell those shares, there will not be any taxes, at least immediately, at least not associated with the sale of the stock. Taxes from individual retirement accounts, and all retirement accounts for that matter, are typically only on withdrawals. So in a 401k or an IRA, it's not till you withdraw the money that you pay taxes, but it's a different tax table that's used. Ordinary income tax rates, which are as low as 10% and as high as 32%. And we could see these going up in the next 5, 10, 15 years, something to definitely watch out for. As a result of this, her total taxes based on selling the stock and withdrawing that money, the $400,000 worth of stock 10 years after retirement, was $128,000, more than double the tax cost from the NUA strategy. So maybe not the most common scenario to be making a $400,000 withdrawal 10 years after retirement and selling all the stock in 1 year. That would definitely be something that we would be cautious of as advisors and be encouraging her to consider maybe a different route on both of these scenarios, by the way. But this is a good example of how net unrealized appreciation can have substantial tax savings, especially for somebody who has more than $200,000 worth of stock. Some of our clients have more than $2 million of stock, and it creates an even bigger opportunity if administered correctly. So when we help somebody retire as advisors to the retirement group, we will call Voya with you. We will put an analysis together before we even call Voya, tell you about why we think you should do what we're telling you to do, what the risks are, what the upfront tax impacts are, what are the likely long-term tax impacts are. And then ultimately, it's up to you if you decide to take us up on that. We'll walk you through it and call the administrator at that time so that you can get all this done correctly. All right, without spending too much time on this, we definitely wanted to bring up the interest rates that changed and are changing. They're going up into the first quarter of next year based off the September and August corporate bond interest rates, as well as the treasury rates. They are all higher, meaning that if you're still working at ExxonMobil in the first quarter and haven't rolled over your pension yet, you're going to lose some money on the lump sum in almost every scenario. So what you're looking at here, quarter one, 2024 blended rates, 5.52, 5.59, 5.50. Those are for non-grandfathered employees, whereas grandfathered employees get 4.00% associated with the 30-year treasury. All of these have gone up roughly 0.5%, which could mean 3, 4, 5, 6% losses on lump sums going into the first quarter. Now we're already into December, and as a non-grandfathered employee, you would have had to retire by November 30th and commence your benefit December 1st to lock in the fourth quarter interest rates, the more favorable lump sum interest rate. So it may be too late for you if you're still working. However, it's certainly possible we may see some rate cuts next year, and there could be some more favorable opportunities to take a lump sum for those of you that are still working, or for those of you that left the company but just still haven't pulled the trigger on your pension benefit for whatever reason. Unfortunately, statistically, we found that 74% of Americans over the age of 50 do not have a written plan for their retirement plan, which we believe is absolutely unacceptable, given how important all of these things are to the sustainability of your money in retirement and your lifestyle after you leave ExxonMobil and after you are financially independent in retirement. Take us up on the cash flow analysis, folks. It's a complimentary service we offer for everybody at ExxonMobil, whether or not you're a client yet. Even if you aren't even sure if you're intending on becoming a client, this is a way that we can add some value into your retirement strategy. And all we ask is if you get some value from this exercise, you help us to grow our business by recommending some of your coworkers talk to us. It means a lot to us. So let us know if it's been a while since we've updated your cash flow analysis, or if you'd like to do one for the first time. It doesn't cost anything other than typically about 20 minutes of your time to gather the information that we need, and maybe half an hour to an hour to cover it on a web meeting or an in-person meeting in the future. With that, we're going to wrap it up today, although we may have some questions. So Sam, if we did have any questions, we do have some time. I'll let you go ahead and ask them, and we'll see if we can get them answered.
Yeah, Tyson, let's answer just a couple questions. Are there state-specific tax considerations I should be aware of when employing the NUA strategy?
That's a really good question. That's a thoughtful question. To some degree, yes. Now, there's no state rules where states won't allow you to utilize NUA, but remember, every state taxes income and capital gains differently, and that needs to be considered certainly for the timing of when you're doing your NUA distribution. For example, if you lived in, let's say you lived in Texas during your career, but you're moving to Colorado, a state that does tax income in retirement, you might want to do your NUA distribution before you make the move to Colorado, so that you don't pay additional state income taxes on the cost basis of your shares. That's the biggest tax state-specific consideration that I can think of. And then just, of course, nobody knows exactly what their retirement's going to look like. but just trying to prepare for the possibility of changes happening after retirement and utilizing these strategies when they are most favorable to you, because it might be less favorable down the road.
Alrighty, got it. Thank you for that. Next one, what is the optimal timing for taking distributions to maximize the benefits of the NUA strategy?
That's going to be on a case-by-case basis. It has the most to do with what you expect your total income to be. The best time to utilize the NUA strategy, if you have a substantial amount of cost basis. Let's say, we had Lucy with $50,000 of taxable cost basis, but if you're, $100,000 to $300,000, which again, you get to pick on how many shares you're utilizing the strategy with. And that might also change how many shares you decide to utilize the strategy with, depending on what your total income is. You may not have flexibility where you're going to have any low income years, but the best time to do it is typically when you have low expected ordinary income. And so the cost of getting those shares out of your retirement plan is as cheap as possible. I also have clients that they need money. Most of my clients, as soon as they retire, especially those that don't go back to work, the options are to take money out of a retirement account like an IRA or their 401k, which is all taxable as ordinary income. Or in many cases, we've done utilize the NUA strategy in the beginning of the year. And rather than sending them money from their IRA the entire year, we sent them money from that non-qualified brokerage account that we sent those NUA shares to. And the withdrawals from those accounts are not taxable. However, they still had some ordinary income taxes from the cost basis of the NUA distribution. They're also going to have some capital gains if we're having to sell ExxonMobil stock, because that's, in many people's case, the only asset in that newly created non-qualified brokerage account. But in most cases, even those taxes, the cost basis as well as the capital gains associated with the sale of the stock, is going to put them in a lower effective tax bracket in most cases compared to just pulling all the money they need from the year out of their IRA. So there's a lot of ways to slice this up. Everybody's situation is different. We need to know a lot about you, what your plans are in the future, your sources of income, your assets. And that's why we start with that cash flow analysis, so we can get an idea of those things and then start to back into what's likely the most favorable distribution strategy to minimize your taxes without hurting you from an investment standpoint in the long run.
All righty, Tyson, thank you. I think we have time for one more, but before I ask this question, Tyson, just want to remind everybody that if you would like to speak with Tyson further, you will be redirected to our website homepage after this webinar, and you can book an appointment with either Tyson himself or one of his colleagues. Please take advantage of that. Alrighty, Tyson, last one. What effects does the NUA strategy have on my retirement eligibility for required minimum distributions, or RMDs?
Yeah, great question. So just to clarify, once you turn what is now age 73, and for some folks it will be age 75, IRS makes you start taking money out of all of your qualified retirement accounts so that they can start collecting taxes. That number is going to be a function of your age each year, and the percentage that's required goes up over time, but also the value of your account, the end of the prior year, value of all of your accounts in total. Now, the question is, how does NUA affect required minimum distributions? Well, a couple ways. One, if you decided not to roll over your 401k right away from ExxonMobil for a number of reasons, you might consider doing that. Complacency could be one of them also. Once you reach the age of required minimum distribution, let's call it 73, which is many people over the next few years, that's what it will be. They're going to force you to take money out of that 401k plan and pay taxes on it. That could be your triggering event, or you're forced to utilize the NUA strategy. Otherwise, you might lose it for the rest of your life until you either pass away or go on to disability. So it could negatively affect your flexibility with utilizing the NUA strategy for not allowing you to defer it as long as you might have otherwise wanted to. Now, I think what's equally important to mention is that when you do an NUA distribution, you do your rollover, you take the low cost basis shares out of the plan. That taxable event the income tax associated with the withdrawal of those low cost basis shares that you're utilizing the strategy with can count toward your required minimum distribution. And so that in some people's, in many that we've talked with cases in the past, that's a catalyst oftentimes for people to finally do their NUA distribution and rollover because they had to take money out that year from their 401k anyway. That's not to say it doesn't make sense to do earlier. More often we do it in the first year of retirement, sometimes the second year if income was really high in year one. But you can count the distribution associated with NUA, the taxable distribution, as part of your RMD. For many people, it's going to cover the entire RMD. For others, it might cover most of it. But a very good question, a very thoughtful one, and pretty important to navigate those things because they are affecting one another.
Alrighty, Tyson, thank you. That was all we had time for today. I want to thank you all for joining us today. Thank you, Tyson, for all of your knowledge. Everybody, have a good afternoon, and we hope to see you again soon.
Thank you, Sam. Thanks,
Bye.
folks.
Thank you.